There we go.
All right, everybody, thank you for joining us for another edition of the Make It Happen Multifamily webinar series. We do these once a month, every month on the second Tuesday of each month, where we bring to you, the wonderful audience, and our guests to be able to come and learn in a collaborative environment. We do our best each month to bring on an amazing guest speaker to bring their immense knowledge base to our audience. And then just to let you know, we also record these videos and then we post them into the Make It Happen Multifamily YouTube channel. So for those of you who are listening or watching on the YouTube channel, thank you. Don't forget to press that like and subscribe button so that you continually get updates each time we add new content to the YouTube channel. We're here to make it happen. So my name is Lee Fjord. My wife and I are the founders of the Make It Happen Multifamily Group.
I'm Megan, by the way.
Megan right here with me. And this evening, I'm really excited because we have Sam Passanisi here with us. He has been investing in multifamily since late 2021, has invested over 7 figures into currently 13 deals, soon to be 14, 15, 16, and, is using multifamily for what I hope to do in our future, to turn it into my greatest investment vehicle, multiple investments into multiple different syndications with multiple different operators to show them or to be able to provide my family with income into many years into the future. So, Megan.
Yeah. So with that being said, yeah, our company is Green Forest Capital. We are a real estate investment company, started in 2019. We focus purely on 100 plus unit multifamily syndications and partnering with limited partners. Our partners make the dreams happen. And, we're also the founders, Lee founded the Make It Happen Multifamily Group. It's a Facebook group. We also have the YouTube channel, as we mentioned, totally focused on value add networking and educating the community. We just believe that a rising tide raises all ships, and we want to give back as much as possible because this is a team sport here. So that's us. We love the Make It Happen Multifamily Group here in St. Louis. We also do tours and pours. It's another event we do in addition to our monthly webinars. So with that being said, Lee already did pitch a little bit, Sam, but we want to, bring Sam on and let him tell you a little bit about his investing history.
Thanks for jumping on, Sam. We really appreciate it.
Very good. Can you hear me okay?
Oh, yeah.
Oh, yeah.
Perfect. Well, first of all, where did you get that photo of me? I mean, it makes me look 20 years younger.
That's a good thing. Yeah, I think it came off of your LinkedIn profile.
Yeah, probably. It's a great photo. That's for sure. A little bit about myself. I started in the construction business over 38 years ago, and I've been in construction for that long, and it's been great. I love the industry. I started out as a carpenter, framer, framing track homes and framing homes during my college days, during the summertime, and then was offered a job at a development company building track homes, and I was a superintendent, and then moved up to project manager, and the projects became larger and larger, and the company became larger and larger. And I did that for almost 10 years. I'm a licensed general engineer and building contractor in the state of California since 1986. I also have my electrical contractor's license. I bought my first single family rental in 1987 when I was 25. It was a single family home, and I rented the house out. I kept on buying and purchasing and flipping single family homes with my brother, who's on tonight on our web. And for the next 10 years after that, we bought and sold property. And then as my parents got older, my brother and I, we fell in the footsteps of managing their retail centers because they had property in retail. So it was retail strip centers, and my brother and I managed that for them. Presently, the past 20 years or so, I've been working for an electrical contractor in the past four, and it's a mid-sized company. We do about 100 million a year, and it's not huge, but it's huge by a mid-sized company. And past 4 or 5, yes, go ahead.
No.
Oh, we were just saying, pretty good size company.
Yeah.
For the past 4 or 5 years, I've been an officer and president of the company, and taken it to the next level. How I got started in multifamily was my son and I, who's also on the webinar with us tonight, Samuel. I kind of coerced him into attending a 3-day real estate workshop back in 2021, and we went for a weekend, and it was a Friday, Saturday, and Sunday. Into the second day, we were underwriting deals, and we were learning how to underwrite deals. And he took it on so quickly, and he did a very good job of it. And he lost me. The numbers were a lot faster than I can keep up with. And he looked at me by the end of the third day. He was like, "Dad, I could do this." And I met somebody there that was putting together he was actually raising capital for a deal. And unbeknownst to me, one of my first deals was with Lee and Megan. It was one of my first deals back in 2021. And I mean, we just got to know each other over the past 6 months, and didn't realize that two and two, got together like that. And anyway, so I've been investing in limited partnership deals ever since. And the first syndication was in 2021, and invested in 13 deals since then.
So you didn't realize that your first investment was our investment until this year.
I did not. I did not. I was dealing with the capital raiser, and I actually, he's the one that really convinced me, and he really didn't convince me. He was telling me about the deal, and I looked at it, and I think I attended one of your webinars. I can't remember if I did or not, but and I saw that, and I started investing in syndications ever since then, and large ones, small ones. So and it's panned out well. It's really panned out well. Now, I don't consider myself an expert, and a lot of these notes that I put down together and things I'm going to be talking about is based on my experience levels. And I just suggest to everybody that they do their homework anytime they invest in anything.
And you've had some other passive investment experience other than multifamily. You've done other types of.
I've done retail. I just got out of a small office building that I partnered with two other friends of mine, and it did very well. It within 3 years, it turned a 35% per year profit for me year over year. And I wanted out. I took my money and I put it in multifamily. So I'm constantly, I'm sold on multifamily syndications.
Yeah. What is it about multifamily specifically that you love more than the other types of real estate investing you've done?
Well, I mean, there's two things about it. I'm now venturing off into, stepping into general partnerships now, and also co-signing on loans and co-sponsoring, which is great. But what I like about limited partnerships is it's hands off for me. I don't have to, with the single family homes that my brother and I were managing, we would get calls, the toilet's backed up, the electricity's not working. And then they would complain about, the light bulb is burnt out. And some of these places were an hour and a half away I had to drive to, or I had to call the electrician at $150 an hour.
Right.
So, when you're dealing with single family homes, it's a little bit different. And it's a great investment if you've got the plan. I didn't have the plan. I was young. I was in my mid-20s. And it's great if you have one or two of them, or if you've got a duplex or a fourplex, you want to just manage and just do that. That's fine. But for, onesie, twosie type single family homes, it wasn't for me. And we look back now and glad we're not in it anymore. And now that my brother's actually invested with me on some, actually one deal just recently on a multifamily syndication, and he's learning about it too. So I'm bringing in as many people as I can into it, because for me, it's hands off, and the general partner and the asset manager's got to take care of it. So I like it. What I also like about it too is the preferred returns. you get cash flow.
Yeah. I tell you what, Lee and I started in the single family duplex, 4-family space as well. And we still have some of that. And it still takes up 15 to 20 hours of my week. Yeah. Like, that's why we're 100 plus apartment complexes with on-site property managers from now on, never, ever again, the small stuff.
Slowly but surely selling off all of our smaller single family houses and small multis as quickly as the tenants move out. We are selling houses and turning that money into equity that we then invest as LPs
into our
own and other people's syndications as well.
In the future here.
Yeah.
So, all right. So, there's 3 main areas whenever we're talking about, we're talking about vetting syndication teams tonight and vetting deals. And there's really 3 kind of areas that we're looking at when we're vetting a syndication team or a syndication deal, which is the team, the market, and the deal. So first, let's look at the team. Sam, what are you looking for in a syndication team when they bring you a deal?
Oh my gosh, that's really important. Well, how well do you know the team? And that's really important to me. Their experience level, their track record. And by the way, I'm going to ask questions of myself because I'm asking questions of the web people online here because they're going to be asking the same questions. And and by the way, the first couple of deals that I jumped into, whether it be 25,000 or $500,000 or whatever it was, I didn't ask these questions. I really didn't. This has all come with experience and more deals I've done, more I've learned, and I'm still learning, by the way, folks. So you need to create your own questions too. So if there's questions here or there's bullet points that aren't on here that you want to know about, now's a good time to ask because you've got 2 experienced people, Lee and Megan, and actually other people on the web line here that have a lot of experience. And what you want to do is surround yourself with people that are smarter than you. That's what I do. I hire people that are smarter than me. And so what is their experience level and track record? Have they done these deals before? Is this their first deal? If it is, that doesn't scare me, but I like to know what their plan is. Is this team you can trust and work with for the next, 5 or more years? Some of these deals go from 3 years to 5 years. Some deals go from 5 to 7, and they've got $25,000 of your money. To me, that's a lot of money. You've worked hard for that, whether it's your IRA, your 401k, or it's cash you borrowed from your credit cards, or you borrowed money from your 401k in order to invest. That's really important. Does the team have the same values and plan as you? The whole period. I mean, if you want to invest $50,000 and you want that back in 1 year, well, I'm sorry, folks, but you're not going to get that $50,000 back at the end of 1 year. If that's the case, go invest it in stocks and bonds where you can buy and sell and do that sort of thing. These hold periods go from 3 to 5 years, and sometimes longer, depending on how the market is. What is the team plan for creating more value? What's their goal? Is there a value add, upgrading the property? What do they plan on doing? How do they plan on selling this property and making more money for you? You got to remember, if you're on a team and the general partners are talking about me, run, folks, because it should be about you, and making money for you, the limited partner. They've created a plan to make an extra dollar for you. So if they want to double your money, if you want to double your money and they're going to give you an 8% preferred return per year, let's just say, sometimes a little bit lower, sometimes a little bit higher, depends. And they're going to double your money in 5 years, that's 20% ARR. Then you want to make sure that they're giving you your money first. And if you're not first in line, run, because that's where you want to be. The general partner should be there making sure that you're going to make money, and they should have the limited partner in mind. What's their prior experience? Does the team have a construction manager on board? Does he know how to build CapEx? Is there a finance person on board? Is there a real estate person on board that's got experience in real estate or property management? That's really important. What's the team look like? If the team is not comprised of 5 or more people on a deal that's 144 units or 200 units, folks, or if it's just a 2-person team that's saying that they're going to do everything, that's not going to work. You really need a team that's going to spread the wealth where they're all going to work hard to make money for you. And the other thing too, I always look at, are they underwriting the projects conservatively? If the general partners are not underwriting the projects conservatively and saying that they're going to get you 18 to 19%, I would rather go into a deal that's they're saying that they're going to give me 18 or 19% rather than some other syndicator saying that they're going to give me 25 or 30%. I would run because they're overinflating everything, and you really don't know what they're going to return.
Right. So backing up a little bit, you hit so many good points in there, and like all of my questions.
I'm sorry, it's just a lot. I just rumbling down. I'm writing all these notes down. I spent the past week kind of coming up with all these ideas, and go ahead, Megan. I'm sorry.
No, you're fine. You're fine. This is good. So you talked about the experience level of the team. And you mentioned a little bit, hey, have they done this before? New people don't scare you, but I think, when we're talking about the size of the team, like there's those two things come into play, right? It's like, hey, it's okay if you have someone who's brand new on the team, but who are they partnering with? Like, how are they filling those gaps? Like, is there someone who has a significant amount of experience on the team that person can learn from and be held, in check for, and, make oversees what's going on? Is there, you mentioned on the downside, a 2-person team, for something, and also real quick, like, have you only invested in like larger, like 100 plus units since you've gotten into the multifamily investing, or like what kind of size have you done and what kind of team size are you looking at? Is what raises a red flag for you based off of the deal size?
I'll be honest with you. I like the 100 unit plus because you figure if you've got more units, you have less risk too. And the reason I say that is that what happens if 10% of the people leave? Now you're down, 10 units or 20 units or so. I'd rather be in a deal that's 150 or more, or 125 or more, something that's got some value to it, that in case there is a 5% vacancy factor, that you can cover the nut, you can cover the loan. And that's really important to me. And that's what I look at. The size of the team is important. The other thing is communications. I mean, I had one deal where I tried to get a hold of the asset manager, and they didn't have anybody in investor relations. I didn't hear anything from them for 6 or 7 months. And I was on the phone trying to get in, talk and, leaving messages, and nobody returned my call. Finally, we got a 1-year report stating that their CapEx has started and, their rents had leveled out. And well, what took them so long? It should be, in my opinion, a quarterly report.
Yeah.
It doesn't have to be.
Money's gone at this point.
Yeah, we do.
Oh my God, I've seen quite a bit of craziness, and it doesn't have to be a complete detail. I got one syndicator. He gives me, Mrs. Jones was late on her rent, and it shows right on the 122-page, financial report on the quarterly report who was late. Mrs. Jones was late, and her rent was this and that, and I don't need to see all that. I don't care.
Full transparency.
Go ahead.
Oh no, we're saying that's full transparency. Yeah. That is
too much. There's a
fire hose.
Sounds like there's a happy medium there. That
exactly. I mean, I've seen it where I haven't received any information, and then I've seen it where I've got too much information, which is fine too. I just kind of I copy it, paste, and file it in my folder, and I'm done with it. I don't go through 122 pages with the financials, for the quarterly report. So it's really important for me. Communications is really important because I like to know, have they started their CapEx? I just recently received one. It said, hey, CapEx is this. We bought all the cabinetry. We bought all the flooring. We bought all the materials. Oh, and by the way, we bought the bulk of all this material. We put it in a container. And now we're saving money because we bought it in bulk rather than buying one unit at a time and one, appliance at a time. I had that happen too, where all of a sudden the syndicator comes back and goes, well, the appliances are more expensive than we anticipated, and we need to raise more CapEx money in order to pay for the appliances. They figured their numbers.
Yeah.
So they underestimated it. So that's really important. And I'd like to know that. But anyway, investor relations is really important to me. Communications, even if you're saying, hey, we're down on rents, at least we know. The limited partner is invested his, 25,000 to wherever, $500,000, and they want to know what's going on with their money. Are they going to keep you informed every quarter or just once a year? That's a question that everybody has.
Yeah, for sure.
Sam, I have a question specifically about that. So let's go into just quick bullet point items. How frequent do you want to hear from your general partnership team? What information do you want to be receiving in those reports? And who is it that you want to be hearing from when you receive those reports? So if you could just kind of briefly describe how
often, what information
you want to see in there, and who's it coming from?
Well, I mean, I've seen it come from the asset manager. I've seen it come from a specific investor relations that was appointed by the GP team and or marketing person that is close to the asset manager. They have their finger on the pulse. I mean, if you're getting a 1 or 2 page quarterly report, I like to see it quarterly, to be honest with you. I mean, I like to see it quarterly. Every 3 months is not bad. And it just tells you what's going on. And it doesn't have to be more than a page or 2. I mean, you can fill in all the information, what the rental, what the occupancy factor is. Have they started on their CapEx? Have they started on their, their value add into the units? What, have they stabilized the rents? And then I like to put a caveat to all this too. If somebody wants to see the financials, you should be, or the general partner should be, an open book. I mean, if I want to see what's going on in the numbers and where the money's being directed to, we should have the ability as a limited partner to ask the question and say, I'd like to see it.
Yes.
Mm-hmm. And the asset manager should be able to, within seconds, send an email out. I don't think it needs to be part of the quarterly report, in my opinion.
Right.
Yeah. So what we do is we provide a monthly report through our software system, that we utilize for managing those. And then we do a larger quarterly one that kind of covers not only the bulk of the monthly aspects, like the change in rent amounts, but also, covers a distribution as well. So that's what we do. One thing that we also love to add are photos into our communications to our investors, photos of, the team, the on-site team, so that our investors know that it's not just about money. It's also about the people. Right. It's about introducing our investors to the people who really make it happen. Mm-hmm. The on-site team. You're one of our investors on those deals. Is that something you like to see? Is there anything else that we can be adding? And, we'll save kind of ground questions for everybody else towards the end, but is there anything else you want to add there?
I like to see if you've done, a before and after photo of a value add, and say, this is the before picture of what this apartment looked like. Here's the after picture of what we've done. And by the way, we've raised the rents from $800 a month to $1,200 a month for this 2-bedroom. And we're getting it in the market. That's exciting, and the more excitement that the GP team breeds with the LP, more excited I get, because I see value.
Yeah, for sure. Yeah. And we love to show, not only, of course, we love to tell the numbers, but we also love to show just how we're, it's a people forward business that we're in, and we want to improve communities. Like, we add value to everyone that we work with. And that includes our communities that we're currently making better every single time we do one of these value add deals. Yeah. So anyway, continuing on. So any other questions about vetting the teams? Like, have you ever done any kind of background checks or like previous investor interviews? I've heard that some LPs do like to, hear from other investors who've invested with the deal, the team previously. Are those some of the things that you've done, or?
That's a good question. I have not done a background check, but I'd like to know what the person's background is. What does the team, again, back to the prior experience. What's Lee's prior experience? What's Megan's prior experience? What's my prior experience? And you want to know, maybe if somebody's asking, that we should have, or you should have, that the general partners be made available where they have a resume and they could be sent out to the limited partners upon request. That's important because, again, the GPs are managing your money. They really are. Even though it's invested into the property, they're still managing the property. And I want to make sure that Lee Fjord has a background on managing this property correctly. I don't know if he was a garbage man before, and maybe he was. I don't know. And now he's a real estate salesman. I mean, I'm not knocking garbage men. Believe me, they make a lot of money. But I'm telling you, I just want to make sure that the team has the experience. That's really important to me.
Absolutely. Absolutely. Okay. So let's move on to the market. When you're looking at a deal and vetting a syndication team in a deal they're presenting to you, what is important about the market?
Oh boy, that's reason I'm laughing is because most of you know who Jamie Dimon is. He's the CEO of Chase Bank, and he put out a little flyer out last week that said, the market looks so good, I don't anticipate a recession at all. Well, what the heck? I mean, everybody has said, oh, recession's coming. And all of a sudden now Jamie Dimon senses out and says, well, the market looks good. People are still borrowing money. And I don't foresee a recession coming. Well, I mean, everybody's got an opinion about the market. I'm the type of guy that says, okay, if I'm going to buy a house, and I learned this a long time ago, if I'm going to buy a house in a neighborhood, I'm going to buy, excuse my expression, the most dumpiest house in the neighborhood that I could fix up. Yes. And excuse my expression, folks, the shittiest piece of single family home that I'm going to buy, fix up, that I know that 2 doors down, it's going to turn into $1 million home later on because they're selling for $1 million. So, folks, if you're going to get into some sort of investment, do your homework. I don't expect your GP team to do their homework. That's their job too, in order to bring a deal to you, but you need to do your own homework. Does the market support the investment opportunity? If we're buying a 150 unit, the GP team has got a 150 unit apartment project that they're proposing to put together as a deal, as syndication. What are other apartments renting for? What's the comparables in the area? Has the team completed a market study on their own? Right. I'd like to see that. Have they done a comp or a comparable status of other apartments in the area compared to the property they're proposing on buying and purchasing? Is the overall growth and economic status there? What is there going to be employment growth? There's going to be economic growth. Is Oracle going to be in the area, and all of a sudden they're going to be hiring 20,000 people? And all of a sudden, then everybody's got jobs in that area. The other thing too is that if they're only paying $10 an hour and they can't afford your $1,200 a month rent, that's a problem.
Right. Mm-hmm. That's a big thing to look at. Hey, what's the average? What's the median income in your in the market area? And does your rent, make sense? That's a great point.
I live in San Diego, and the rents for a 2-bedroom and 2-bedroom and a den in San Diego is just atrocious. I mean, don't get me wrong, I make good money, but still, I look at it and I die every time I send that rent check in. I know a couple of people here on the webinar are from California, so they know. I mean, it's probably one of the most expensive states to rent and to purchase a home in the entire U.S. One of the probably top 5, and San Diego's is probably the worst, one of the worst. So anyway, you've got to find out, will the property sustain, increased rents? Well, it will if you do maybe a CapEx and you want to compare it with other properties. Can your project, grow during the duration of the investment? The next 5 years that you're improving this property with the market, will it withstand granite countertops, or do we just stay with tile? Do we spend too much money, or do we just keep it just, middle of the road? Or do we look at what the market's at right now and go into a Class A property and say, if the Class A properties are renting out, a 2-bedroom for $2,000 a month, but yet a Class B or C property is only going for 12 because they've got tile countertops or maybe white appliances. So there's a lot that goes into a market study and to what goes into the area. So it's not just the market, it's the area too.
Demographics, yeah. Real quick, Jim Volner had a question. You want to jump on real quick, Jim? No.
Got it. There we go.
There you go.
Unmute.
Maybe you can unmute.
Got it.
You can do it.
You can't make him unmute.
I can't unmute you.
You're still muted.
Yeah, it's all good.
You can always type it in the chat.
Go ahead.
I have a specific question. When you look at a deal and you're evaluating whether or not to invest in it as a limited partner, do you personally visit the property before you invest? Do you feel like that is something that you want to do or need to do?
You know what? I've bought stock in Disney before. I've never gone to Disneyland.
Love that. Yeah.
A lot of people buy stock in Oracle. They don't go to the company. I mean, that's your job. As a general partner, that's the general partner's job. I'm just a limited partner. You got to remember that. I'm hands off. That's what a limited partner is. I want to do the least amount of work as possible. And that's your job as a general partner to do that job. And so I rely on you, when I say you, the general partner, to do that job and come to me with the market study, come to me with the deal, come to me with what you can prove to me that will make a good deal for me later on in life. I mean, the thing is that it's no different than me investing in stocks, which I don't do a lot of, but if I invest in stock, I look at what the market's doing. I look at where it's going. Will Disney stock go up? In my opinion, I've always liked real estate. My dad's been in real estate. My family's been in real estate and construction, ever since I was a little kid. My grandmother, who passed away at the 109, she was 95 collecting rents from her commercial buildings, knocking on doors, asking for her rent. So I come from a long line of construction and real estate family. And I back to your question, I'm getting off subject here, but I like this market. I like the real estate, and it's the general partner's job to visit the property and do their job. I mean, I don't have time to fly out to Ohio and Georgia and whatever have you to look at the property. I want pictures of it, and it's a GP's job to sell me on it.
Real quick too, Sam, do you look at, when you're talking about the market, do you look at cap rate of the purchase? Like, are you looking at, hey, like, what's debt look like? What's the cap rate look like? Are those things that you're analyzing as well?
Well, I mean, that's part of the deal. I mean, that's the next segment. And when we'll look at the deal, and we can go back and forth, that's fine. But I personally don't look at cap rates. I mean, I leave that up to the GP, but I do look at what are they going to do with the property in that market? Is it a floundering piece of property in a market that, again, is it the black sheep of the apartment complexes in all the apartment complexes? What's that comparable to the other apartments? And that's what I look at too. Is there upside for that apartment complex to go up in value? And that's the first thing I look at. If I'm investing in a Class A property, well, it's not going to be much growth, but there's going to be some income, and I may get 8 to 10% return on that. I'm not going to get a lot of upswing on a Class A property because everything's been done on it, and so you're going to get your 3 to 5% increase every year. On a value add, it's going to be different in a market that you have upswing.
Right, and you mentioned, so looking at the dumpiest or the black sheep of the neighborhood. But I know that you've also mentioned that one of the things that's a red flag is like too much construction, or, so like when you're looking at these deals, you know, you're also looking like, hey, like, does the value add plan make sense? Like, is there a huge construction budget? Is it a heavy lift? Or is it more of a management play? Like, can you speak to that a little bit?
Again, one more time, I lost you on that. I apologize.
So we're now focusing on, we've moved from market to deal. And, the real question is, what are the key aspects of a deal that you look for individually? What are some huge red flags that you would run away from? And, and are there any deal specific aspects? I do have a follow-up question on market, but we'll get to that at the end.
Well, my red flags are going to come at the end because I've got a couple of red flags to look out for. But the investment strategy, what's the plan of the general partners? Are they going to go in and replace roofs for $500,000? Are they going to go in, there's a pothole in the middle of the road. Are they going to replace that? Are they going to, I think this is, in my opinion, the team and the deal is the most important thing. And the market is too, but identifying the goals of the deal. What are they planning on doing to increase the value? Understanding the business plan, because the general partners have to come up with a business plan. What's their plan on increasing the value? And that's what I look at. I mean, that first thing I look at, what are they going to do to make this, $10 million piece of property turn into a $25 million piece of property? And how are you going to increase the rents? That's the first thing I look at. So I want to go ahead.
Yes. Sorry, I just wanted a key, like that's a foot stomper right there, because specifically in commercial multifamily, the way that you increase value is increasing the rents. So if you're doing a construction business plan, but it's like plumbing, it's things that don't raise rents.
Yeah. Roofs you're not, don't increase rents.
That's not gonna make your money on your money, So those are great points.
There's got to be. There's got to be a return on your capex, and if there's no return on your capex and it's not figured into your business plan, get out of it. Don't even look at that deal. And then the other thing too is that you need to understand their exit strategy too. Are they just going to, when I say they, the general partners, when you're looking at these syndications, are they going to just, change all the flooring and put a coat of paint on and change a couple of appliances and not raise rents and all of a sudden, it's going to be worth $25 million later on after you bought it for 10? No, you need to raise rents in order to increase value. You need to see the projections and the expected distribution schedule. It's one thing if they show you a projection and expected, distribution schedule based on the 3 to 5 years, you want to understand that and ask the questions, especially when you're in a webinar and they're trying to solicit or sell the deal to the limited partners for a raise. What's the background of the property? Does the property have a story? Did it have bad management originally? Was it a mom and pop property? Was this property in a family for 20 years and now Uncle Joe has gotten old and he can't manage a property and he can't clean the toilets anymore or change out a toilet because maybe mom and pop have moved into one of the units and they were managing it as part of their job. So bad management, so it's a big thing. And if we can come in there and change out the property manager and change out the background and you know what, you change it from a different name, change the color on the property, change the roof colors, change the stucco color, and all of a sudden go from a dreary gray to a bright white or something to that effect. That's important because it just changes the whole neighborhood when you put a coat of paint on. Or even cutting the lawn is a big thing,
Yeah, real quick, Joe Allen had a question. Joe, can you jump on? Hopefully we don't have another unmute issue.
Yeah, no, I'm here. I kind of lowered my hand. Thank you guys for holding this, by the way. We had to get off one Zoom and get right on. I was kind of late. But what he just mentioned right now about operations, So at first he said, if you're just going to put a coat of paint on it and this and that, it may not be worth our while to increase our money. But then in my head, it popped in there. If it is bad management, if there is something going on and they're paying for the water or not using rubs when they could, or, some of these operations that are, vital to making multifamily, to creating the appreciation or depreciation, is that something that you're also looking for? And you answered that question kind of as I had my hand up. But to me, even if it was just slapping some siding on and painting the trim, changing the sign, making it beautiful, showing where the leasing office was, and then changing the operations, that to me could be a huge, huge opportunity and asset, correct?
For sure.
100%.
Agreed. Changing the name of the property from Park Place to Boardwalk or something. I don't know. I mean, it could be anything, and maybe affiliate it with the community. That sometimes, the people that are living there do not have pride of ownership. I mean, you want to walk around the property and take a look and see, do they got a bunch of trash sitting outside the door? Do the tenants just throw their trash outside the door and they don't want to walk down to the trash bin? Maybe they don't like living there, but yet the rent's cheap, and so that's what they do. Or they've got a bunch of junk on their patio, and in your lease agreement, it doesn't state that. Well, that's going to change. There shouldn't be junk on the patio. And if there's graffiti on the walls, that should be taken care of right away. So, that's all, for me, it's bad management.
Exactly. And that's one of the things that we look for the most when we're looking at value add deals is, hey, who are the mom and pop owners who are not professional managers, who are leaving money on the table, who are letting the place be, not investing the money that is needed into the property, which is affecting the rents and affecting the community. Because the thing is, if you find a bad management company, that is the cheapest value add. All you have to do is go in and manage it right. And you don't have to spend a nickel. You don't have, there's no CapEx expense to manage the property, right? And that's one of the things, Sam, the first deal that you came in on with us, it was a mom and pop owner, and they were paying all of the electric bills, even though it was a sub-metered property. Yeah. And it was so easy. We were able to raise so much of the gross potential income. We were able to raise the NOI so much just by giving the tenants their electric bills, which people are used to paying their own electric bills. So it wasn't a hard sell. And that increased the value of the property so much. So we love that. That's one of the first things we look for.
That is the lowest hanging fruit on any multifamily asset are management efficiencies, being able to put in place processes and procedures for establishing renewal processes and renewal minimums, being able to incentivize your managers when it comes to renewals and ensuring that they don't renew a tenant who may be a great tenant who's paying $300 below market on their rent at the renewal. That tenant, they might think, because they have an emotional connection, it's a mom and pop manager, that they think, well, that person should only get maybe a $25 increase because maybe that's all they can afford, or maybe that's only what, we feel like is reasonable as a 5% increase. But what we really want to focus on are finding and putting in place processes where we have a minimum loss to lease. So if the rent is, $800 and they're paying $500, well, we're not going to bring them to $800, but we're going to bring them to,
market
$700
for that rate. Yeah,
we might allow for $100 loss to lease there.
Yeah,
and it's surprising how often you find mom and pop owner operators and mom and pop management companies who don't have systems in place for just even stuff like that.
Yeah,
just literally renew the rent.
Yeah. And addressing, clean up problems as soon as you see them.
Yeah.
Yeah. So
wonderful.
Jim, you want to try again?
Yeah, Jim's turn.
I think you can hear me now.
Yeah.
Yes.
All right. Now you can't see me, but you can hear me. My question was about the deals you've done. Have you worked with any fully integrated businesses? Any fully integrated businesses that both do the property management, asset management, and manage the, I'm my question's more geared towards heavy lift CapEx stuff, because I often work with fully integrated companies that work in that fashion. So are you have any experience with fully integrated businesses, or is most of your experience just in the syndication GP management style?
Like versus using a third party management company, you have it in house as well.
So I guess my question's more geared towards the conflict of interest that comes from working with fully integrated
Right.
businesses.
Good question. Can I answer that?
Yes.
For
Yeah.
sure.
And then I'll leave that on to you guys. I don't like that. I mean, I've seen too much of it. I mean, I'm in the construction business and I see a lot of, deals that are backhanded and where the property manager and or the general partner, I mean, not not Lee and Megan's case, but I've heard of it and I've seen it where, it's somebody's cousin or somebody's brother that will go and do the deal, and all of a sudden they're getting a kickback. I don't like that. I really don't, because way it looks like to me, it's money out of my pocket as a limited partner. It's money out of my pocket because when you're buying in bulk, you're cutting a deal. Buying 10 units of appliances and you're getting a better deal. If the property manager's got a brother or a cousin that's in that same business and the property manager is getting a kickback on that, no go for me. That property manager is going to be out of the deal. I'm going to be firing that property manager and getting somebody else. I mean, I don't know about you, Aaliyah and Megan, but you tell me what your opinion is.
I that it's a regular thing to find, once again, mom and pop owner operators who have their sons or nephews or brother-in-laws working at the property. And what I consistently always see is that person is the one that's walking the slowest, doing the least,
So
walking past trash as they walk past around the property, and they are paid the most. They are incentivized, and yet they're never. It's almost impossible to hold them accountable to a higher level of work product. Now you ask the owner, well, that's the only person that I would trust to do that job, and it's like, well, but why?
Right.
Because he can't quit on you tomorrow. Well, he probably wouldn't, because he's got the best job in the world.
Can I go a little deeper into this? So, I really wish I was on the video here. So my experience comes from the fully integrated business would looks more along the lines of like what you're asking as a shareholder, as the reporting. So generally speaking, the institutional style businesses that I work as a general contractor for will place a on-site project manager when your budget gets into the millions of dollars. So it's to manage a large project and give the shareholders and reporting, but also some sort of logistics to the buying those appliances. Now, I see in the syndication, that's an expectation of the GP pool. Now, that's the question. So basically, it's a tug of war of where that money goes. But at the same time, I often and fairly often and don't get into deals that I haven't walked at due diligence upon CapEx budget design. So I will walk the property with them to help them design the budget and then take over as a GC. And then I do all my reporting to either a controller or a on-site project manager, etc. So really those are all skeleton businesses that, they just have one person on site to, oversee, etc. But they'll have a headquarters at some location. So it's kind of like a second route of information. That way, from my experience, seeing the smaller mom and pops, I get Uncle Harry's and Bob's and Tom's, but generally speaking, when the syndication, some of the flaws I see in that system is putting a lot of weight on the property management company that really wants smooth sailing. So that stress also comes back around with like unexpected incurred like invoicing or some sort of weird thing. That's they'll I call that burning their way out as a management company. They'll try to figure out how to upsell themselves till you don't want their service. So that's kind of like they get their money anyway.
Yeah, and that's where
that makes sense.
Yeah,
Does that make sense to everybody? So have you ever worked with anybody that works like that? And I see, I'm fairly close to Lee and Megan. I see them often and enjoy these things. So I would see somebody that's growing like Lee is, being as I'm used to these institutional companies coming in with crews of 12 guys running an entire region of the country, needing some of that and to service their construction or logistics or integrated part. I see that as the very interesting part of the conflicts of interest, because I've heard and seen it, and I try to sell it. So I'm just kind of curious what your thoughts on being able to do that with a group.
I think that it's a huge value add once you're large enough to be able to have employees that are part of your team that are overseeing the CapEx project management aspect of the deal. What we have historically done is bring on skilled partners as opposed to paid employees. But eventually, as every business grows, you get to a place where you're, A-Rod, for example, who owns, I don't know, something like 10,000 apartments across the country. And you have, at that point, you have employees who are the, regional CapEx manager or is assigned 2 or 3 properties to just oversee the CapEx for. And believe me, we'll get there one day. A-Rod, you better watch out. But we got a lot of time and work ahead of us to get there.
As of right now, as far as conflict of interest in the syndication deals that we've seen, even Lee and I, in vetting other general partners that bring us deals and want to partner with us on stuff, if they have a construction partner who owns a construction company and expects to do all of the unit turns, and then also expects to get a construction management fee
red flag
on top of getting their GP percentage for owning, like that is, hey, you're feeing the deal for something you already get paid on. And then if you're not doing a quality job, you can't get fired. Like there's no firing them if they're not doing it. It's a guaranteed paycheck. Just like you were saying, they're going to do the least amount of work and they're going to get paid the highest. And it's the same thing with the property management. Like, if you want to do your own in-house vertically integrated property management, well, if they don't perform, you can't fire them. And there's they have too much control. So we prefer third-party management, third-party construction, at least minimum 3 bids for a certain size construction job in order to make sure that we're getting the best price, and we're vetting out those contractors too. So, but that's a great thing to look for in a deal, is like, hey, who's doing these things? Are they associated with any of the people on the deal? Because that might be a red flag.
I would ask the question, who is going to do the CapEx and who's going to be in charge of it? I mean, I like it when I'm looking into a deal, or I'm looking in that somebody on the GP team has some construction experience, because now they know what to look for. They know what to read in their exclusions and exclusions. I mean, I read contracts on a daily basis where even my subcontractors exclude everything. And you're going like, no, the RFP says this. No, this has got to be included. So, to have somebody on the team that's got some construction experience or project management experience that read contracts, that's really key. That's really important. And if they've never done that and they've never done a CapEx, value add onto an apartment building, for their first deal, I'd be wary about it.
Yeah.
That makes a lot of sense. Douglas has his hand up.
Yeah, Douglas.
Yeah, that's very good. I really enjoyed this. I deal in a different market though. I'm dealing with hotels. I own a piece of quite a few hotels in Miami Beach area, and I don't know how you would look at it, but what can you tell me? What do you think? Because I've done very well with hotels.
I would stay in hotels. If you've done well in hotels, stay in hotels. Why change? I don't want to say not to invest in multifamily, but if you've done well and your secret's good and your recipe's working for you, why change? That's just my opinion.
There's a lot of work though being in the hotel business. Let me tell you, you have to run the hotels and be there and time and effort, and trying to get retired sometime. That's,
so you're an operator. You're a true operator.
Yeah.
Gotcha. Yeah.
It's a great place to be. One of my I wouldn't necessarily call him a mentor, but a very close friend who I turn to for advice sometimes, is a hotel operator. And man, what he ended up doing, he ended up transitioning from being an owner operator to then selling his entire portfolio. And now he is a professional full-time limited partner. So, and he invests primarily in hotels as a limited partner because he understands the business better than anybody else, better than me as far as hotels goes. Mm-hmm. But he also invests in multifamily, also invests in storage, he also invests in industrial. The goal isn't just focusing on one asset class. So
diversification.
He had the opportunity to be able to sell his portfolio and transition into a passive role and vet and choose which investments and which properties he wanted to put his money into.
And speaking of coming back to deals, so when you're looking at a deal, you mentioned before you invested in a multifamily syndication. I don't know if it was a syndication or a joint venture, whichever, but you found out that they weren't doing quarterly distributions. Like, so what are some of the things that you are looking for in a deal? Like, what about like GP/LP splits? What are your thoughts on fees? Like, what kind of criteria are you looking for in deals?
That's a good question. If they're taking more than 30%, I like the 70-30 split where 30% goes to the GP, 70% goes to LP. It gives me some teeth. It gives some teeth in the game for the GP, and also I like to have my returns too. I like to have a 20% return per year, which doubles my money in 5. I like that. I mean, some of the red flags that we can go into, little to no cash flow throughout the deal. I can't stand that. I mean, I go into investing my money where I'd like to have some cash flow. 5% would be fine. A couple of my deals are giving me 8, which is awesome. The no cash, I've got a couple of deals that aren't giving me any cash flow. In fact, I reached out to the asset manager and I said, hey, when's the first distribution coming out? He goes, oh, this deal's not set up that way. You're not going to get, your return until the deal is closed and we sell at the end of 5 years. I went, what are you talking about? And I should have read the fine print, but I didn't. That was one of my, earlier deals I did earlier in 22. And we'll never do a deal like that again. I can tell you that,
Right.
So, I mean, little to no cash flow throughout the deal, it's not for me. And it shouldn't be for you either, because you're investing your money. Even when you have your money in an IRA, you get a return and you can see a return or loss, but at least you can see something. But, if you're not getting a cash flow throughout the deal, that's a problem. The other red flags I'm going to lead into this, Megan, your question back to, maybe acquisition fees too. A lot of times at the very beginning of my deals, it's like, why does the general partner get a acquisition fee? Well, you know what? Putting together these deals are expensive. Flying out, and I've done this, and my son's done this, where, Dad, I've got to fly out to, Ohio or wherever. I mean, you're flying out on your own nickel, even before the property is in contract. So you're spending $1,000, $1,500 on plane fare, or you're driving out to the property. You've got to go see it. The general partners, if they don't walk the property before they make an offer, run. You need to make sure that they've looked at the property. And then when they do have the property under contract, make sure they're doing a due diligence. Make sure they're walking every unit. Yes, if it's 250 units, they're walking every unit. They're looking at every unit. And if they're not, run, because they're not doing their due diligence. And that's a problem. If you're unclear about who it will be managing the property during the deal, you need to know who's going to be the asset manager, who's going to be your investor relations, who's going to be your construction manager. And there's a lot of, the team has to be slated to manage this property properly. And who's going to be the new property management company? There's maybe not enough people on the operating team. Maybe there's only 2 or 3 people and they're going to try to do everything. That doesn't work, folks. Right. It really doesn't. These deals take a team. They really do. The big one for me, are the general partners investing into their own deal?
That's what I was just about to ask you. Is like, hey, talking about acquisition fees. Well, how much money do not only time and money is spent up front in order to make the deals happen, but yes, if you're getting acquisition fee, like how much money is the GP putting in? Like, what are you looking for?
Well, here's what if the general partners are not putting in, I mean, let's say the raise is $5 million. They're doing a $9 million deal or $10 million deal, and the raise is $5 million. A portion of that's going to use for CapEx or value add, and the other portion is going to be used as a down payment. And if the raise is, let's say, $5 million, the general partner should be throwing in minimum of 10%, which is 500 grand, which is not a lot. It's 500,000 in the general part. Now, not all general partners are going to be putting money into the deal, but I'm talking about total of the GPs putting their money, where their mouth is. And I wrote this on my little notes. I said, are the general partners investing into their own deal? And in caps, I said, if not, run. Because, if they're not excited about their own deal, if they're not investing in their own deal, get the hell out of there. Because the thing is that they're asking you to invest, but they're not investing. Hell no. I wouldn't invest in any deal. The general partners are investing in their own money. Even if they're taking their acquisition fees and putting it back into the deal, that's fine with me, but they're still putting money into the deal. And that's what I like to see. That's important to me. Number one.
Put your money where your mouth is.
Yes.
Our guideline requirement for every deal is 10%, and normally our average is closer into the 25 range. For most of our deals with our partners, from a money that we, the active partners, invest into the deal on a passive basis. Looks like Joe has his hand back up again. Joe, go ahead.
You're on mute.
I'm muted.
There we go.
My bad. I apologize. I'm a little new at this, man. So I have a lot of questions. But when you just said, Sam, take your acquisition fee and re-put it into the deal, what does that mean? That means if I'm going to get 20% or 5% of the acquisition fee or whatever it may be, let's just say it's 50 grand, I could just take that 50 grand and say, you guys keep it? Like, how does that work? What does that mean?
That's true. That turns into a limited partner. So now, not only are you a GP, you're also an LP. So you kind of wear two hats. You are after you're managing your own money too. Not only you're managing all the limited partners, but let's say the acquisition fee on a large deal is 3%. I've seen acquisition fees on smaller deals like a 5 or 6. I've invested in a $5 million deal where the raise was only $1 million or $1.5 million, and the acquisition fee on that was probably 5%. On a $5 million job, they're not, project, they're not going to get a lot for 5%. But on a larger deal, you'll get the acquisition fee will be 3 to 4. And in my opinion, it's well worth it because the general partners are spending, I kid you not, thousands of dollars of their own money up front. Because it takes time and money, and from what I've seen and some of the teams I've been on lately, the general partners are putting their money where their own mouth is right now, and they're flying out to these deals, and they want to be part of the due diligence, and that's coming out of their own pocket. They may get reimbursed or get some money back on the acquisition fee, but let me tell you something, folks. It's not cheap to put deals like this together. It's very expensive, and a 3 or 4% acquisition fee is fair, in my opinion, from what I've seen. And even in the deals I've been in as a limited partner, I think it's fair.
Joe, did your question get answered?
I'm sorry.
Well, kind of. So I want to make sure that I understand I could be a limited partner on my own deal, but when I get that acquisition fee from that deal, I could use that same money back in that deal, or do I have to take money from myself, put it in this deal, and then use that acquisition or the equity from the end of that to another deal?
Yeah, you can literally on the closing, like at closing, reinvest your acquisition fee as the limited partner shares into your own deal. So you would never even get that money. It literally just gets invested right into the deal, and you sign as a limited partner in order to allocate that money.
As opposed to taking cash you don't have to actually transition the money out of the deal and then back into the deal. You can literally just in exchange acquire shares and then void your acquisition fee per dollar amount that you take.
Even if I'm not an accredited investor and you need a 506B or a 506C, however that works.
Right.
So
if
how
you're a
that would
GP,
work, how that would work is if you're a GP on a 506B deal and you're non-accredited, you are automatically deemed accredited for that specific deal because you're a GP.
Oh, I didn't know that. That is amazing.
For both of them. So you are, as a general partner, you are automatically considered accredited for that deal, the deal specifically. You are not just like able to be accredited on everybody's deal.
Only if you're GP.
But only if you're a GP and an active member of the team.
Yes.
Yeah. Morgan, you got a question?
I was just going to add to what to the answer to that question and what Sam was saying is on the acquisition fees and the GP splits with that. The GPs, they're also the ones that are putting the at-risk money up. So none of the LPs are generally doing that. And so there's definitely money that's at risk as you're going through due diligence. You may find something that you were completely unaware of that could be a deal killer. And, at some point in the deal, there's money that's going to be lost. It's not just the travel money and expenses you've spent. Also, just getting out to do your inspections. You have the cost for your management teams and contractors and everybody else that's going to be there as well. So it gets hefty. It's not like buying a single family home where you're just going in yourself with your $500 inspector and you're done.
Right. Just the legal fees for setting up the syndication.
Yeah, that non-refundable money can become hundreds of thousands of dollars before you actually close the deal. We've had deals where literally we were hard non-refundable money over $600,000. If the world had fallen apart or the stock market had crashed in that moment in time, our team would have lost $600,000.
And that's none of the LP's money. That's none of the LP's money. That's GP burdened money. So the GP burdens the majority of the risk here when it comes to that aspect of the deal.
Yeah.
The goal for the GP is to make sure the deal is sound, that it works, that it's good for the LP. Yeah, and Morgan and Lee and Megan are correct. I mean, I've seen it and I'm involved in it where you could lose hundreds of thousands of dollars on the GP side. And that's why you're getting, and you'll get that money back once the deal closes, but anything can happen. So the GP's taking a risk too up front to close the deal.
Yeah.
Jim, you had another question?
Yeah, I hate to ask this kind of question again, but Sam, I really want to kind of present this as a question to a stakeholder. And the idea, so I'm a general contractor for institutional investors. He made a joke at A-Rod because A-Rod Inc., publicly traded company, actually owns a couple of the 1,000 units that I work around. So in that, what I'm trying to understand is not necessarily a pitch to the shareholders, but what is a fair compromise? So say a general contractor was to bring all of the CapEx budget and create the CapEx budget and then execute it. Then there's not that much of a conflict of where the money's going or coming from because they're paying for it and doing the work. So at what point is that situation ever considerable? Does that make sense? So I would, in a perfect world, invest into the GP pool X amount of dollars, but then also, if possible, raise or bring more my own money to the CapEx, a full budget, create the CapEx budget, and then be a GP, but also the GC that basically is funding his own project. So there's the least amount of conflict on where the money and who the money's going to, as if he raised it to doing the work, and if it's built in at 5%, etc., like the model I explained earlier, if there was ever an abort button that needed to happen to where my services were no longer needed there, then if that was in contract somewhere, then there would be 5% cushion for the GP team to actually take that deal back over and allow for some of that, turbulence.
It may work in the REIT field. I mean, are you guys working for REITs? Is that what you're doing?
No, these are mostly public. I'll call them institutional because it's a publicly traded company.
Yeah.
And they just sent 10,000 units.
Yeah, I don't know if it would work in the syndication apartment syndication deals. It sounds a little convoluted to me. I'm not sure how they would work that out.
Yeah. So the way I think about it in my mind as a GC, doing a heavier lift because I've done facelifts, right, and just the renovations. I've been through the smaller 100 units, but particularly right now, I'm working on a 536 unit giant property, 57 acres, all that jazz, right? So we're doing heavy lift stuff. We're rebuilding the breezeways. We're doing a lot of these, a lot of carpentry work, building carports, so on and so forth. That's a big project that if I wasn't able to get my what budget I gave these institutional guys, I couldn't afford to run my company and be able to produce like I do for myself. So I can go GP into something, but if I don't actually get to bring my logistics and my actual full capability to the table, then I don't get to capitalize on that. Whereas I could, at that point, it seems like you could add a lot of value, but not really get reciprocate the return per se. So, anywho, I was just trying to ask you about that to see if there was anything that you would be inclined to hear from a group that had that kind of, I just see there's a lot of struggle from smaller owners. I guess they'd be more mom and pops and syndications, but when they get those $1 million budgets and it's like, the Terry family, they struggle with that project. And I usually get called in and it's a mess by then if that's the case. So that's just my experience there.
I understand. I think Lee and Megan have done a couple of deals where they get 3 bids from each of the contractors, the flooring, the appliance, and they get the best value. I don't know if they get the low number, but they get probably the best value. And they move on it. But I'm not sure exactly what you're proposing or what you're stating on that. It sounds a little convoluted to me, but I don't know, Lee, Megan.
It's hard to avoid I've seen it done successfully and I've seen it done very poorly, but it's hard to avoid the underlying factor of, yes, everyone should be rewarded for their time and effort. The question is, how are you being rewarded? If you're part of the general partnership team, it's understood that your value that you're bringing to the team is generally your greatest skill, which in your case would be CapEx management. So therefore rewarding you on top of your general partnership, a construction management fee or general contracting fee.
Can I say something real quick?
But yeah,
I think it all is going to come down to investor tolerance. Like, how well can you address concerns?
So I'm able just simply go into any project that's fine to a budget, and they propose their budget. I can typically, just based on the fact that I'm gonna front, you got the investor money in, but as far as the general contracting company, being able to pay an installer or direct labor cash, or not cash, but paid on the weekly or quarterly, or instead of these, if you got a rough and tumble process, you will everybody in the industry will know that not to work for you because it takes 90 days to pay, because you got a property manager that can't even get the walls painted, much less get your invoice PO'd, much less get it on the ledger, much less tell their shareholders, and etc. So the system to me is for a contractor to come in and be able to make money by making liquid cash available to the project at a direct rate, if that makes any sense, as opposed to the extended draw process you usually see in these multifamily deals. I can go and deal with labor directly, and just as you would do bulk, you could do that. I could pay cash on a net 2 or on a net 10-day and make 5 or 8% on top of deals I can already make. So it's not only that, but there's other properties. So when you buy in bulk as a general contractor, if you're doing multiple, I can buy more than just what you have and buy beyond your bulk kind of thing. Not saying that's necessary, but on a smaller 100 unit, sometimes it's needed. But I'm just trying to figure out how I could ever bring the full brunt of my capabilities, which is the ability to pay cash or not. I don't mean to say cash, but the ability to pay labor within very quick terms and negotiate that payment to the point I can make my margins in those things, and it could bring the full brunt of what I'm capable of, whether it's my money or actually putting somebody on the job site to report. That's just, there's a value to it. I'm just trying to, I've always struggled with trying to figure out how to present that, or actually
there's definitely a way. Let's take it on a side note, you and I, and we'll conceptualize it together. Sound fair?
Thank you.
Yeah.
Thank you, Sam. I appreciate you here tonight. Thank you.
Yeah, absolutely. Yeah, no, it's you got a lot of value to bring, and it's just gotta making sure that it passes the vetting.
We got a couple other things. So. Jim came out and helped us with our CapEx budget creation for the Avenue project that we recently closed in Fayetteville.
Super valuable.
Huge value. I mean, found amazing ways for us to be able to add value to that project, which just closed back in October. In May.
May,
I'm fast forwarding our life. But
we want to be respectful of your time, because we've got, it's 8:21 now, and we don't want to go over an hour and a half. So continuing on, any last remarks about the deal before we jump into some just general information about syndications that we can keep talking about?
No.
All right.
I have one last comment, and we'll move on real quick. There's also one of the other red flags too is projections. If the general partners are projecting 25 or 30%, I know I'm repeating myself, and similar deals with similar other syndicators are, comparing themselves lower, that's another thing to be wary of, folks. I mean, the bigger percentage is not always the best. And again, that's one of my big red flags too, that, some syndicators out there will say, hey, we'll return 25% or 30%. That's another big red flag, folks. So I know I've repeated myself, but that's another item that you want to move on from. So
for sure, we'll sell this for a 4 cap, the not being conservative with the exit strategy or the business plan.
You can type any number you want into a spreadsheet and then tell somebody it's how the math works, but that's not really truly how a business operates. Especially when you're valuing it at the end of you're projecting it into far into the future. So we're here learning about syndications, and we want to kind of wrap through the process and come from an aspect of I don't understand the notes, but so let's say I have $50,000 to invest in real estate. What should I do? Sam, you have $50,000 in real estate. What should you do?
Well, that's a good question. It all depends. What's the minimum, investment? If it's 100,000 and I don't have 100,000, you know what? I'm going to team up with another partner of mine. Maybe he's accredited, and we're going to start an LLC. He's going to throw in 50. I'm going to throw in 50. Now we got our $100,000 minimum investment.
Yeah, that's a great point.
Easy peasy.
That's a great point. Because if you don't have $50,000 to invest, like you say, hey, I'm just getting started, I've only got 15 grand. Like exactly what you just said can happen. Like you can find a partner and form an LLC and invest in a syndication as a business. And same thing with being accredited, right, Sam? Like,
and if you're non-accredited too, and and the minimum investment's 50,000 for non-accredited, maybe you get involved with another non-accredited investor that you find, or we can put you together that and you both invest $25,000. Now you got your $50,000 investment. That works too, I think. So,
and if you partner with someone who's accredited, if you're not accredited and you find someone who is accredited, then you can invest in a 506c accredited only investment as a business, accredited business.
Yeah. So as a current and hopefully future past landlord, I would recommend taking a share of a much larger asset. If you only have $50,000 to invest, my suggestion would not be to go buy a single family house or a duplex or a 4-family in a transitional neighborhood. It would be to take that $50,000 and invest it into a much larger scalable asset that's going to increase in value under a completely different parameter. So our suggestion and best case is to invest into a large-scale syndication, take advantage of earning cash flow, tax advantages, and benefits from the profits of the sale. Being able to remove yourself from the risk aspects of you're losing your time and effort to the property, as well as signing on loans and having to hire and fire all of the management companies' employees. So our recommendation is to invest passively with active investors, learn, and if your goal is to be active, then still do that. But then learn how they do it. And then so you can go do it on your own. So it's learn, do, teach, so you start with the process by learning and being passive potentially.
Keep doing what you're good at and invest passively. Don't have to learn how to be a landlord.
So how do syndications work? A syndication at the top of our graphic here on our screen is the property itself. Let's imagine a 150 unit apartment complex where it is in a great neighborhood, and we've run through the business plan, we're ready to go through the process. So that property is owned by the LLC. So the LLC is established when the property is put under contract. Then you have two separate classes of folks that are involved in the deal. You have your passive investors, who are your Class A LLC members, who hold passive LP shares in that LLC of the 150 unit LLC. Then you have your active investors, or what are commonly referred to as the general partners or the managers of the asset and of the LLC. So that portion then has multiple general partners under there. So you have passive partners, active partners, and then you have the asset itself, and then you have GPs underneath the manager entity, and then you have LPs underneath the 150 unit LLC.
Yes, and the graphic is a little misleading because there's actually many more. There can be many more LPs than just 4. Like there can be a significant amount of LPs where you're going to have a smaller team, most likely less than 10 people
generally
on a general partnership managing the actual asset. But this is a really great illustration for when we were talking about, hey, what are we looking at in the deal from an investor point of view when we were talking about the split. So here you can see a limited partner owns a portion of the business that owns the real estate. You are a real estate owner. And what's that percentage? Well, that's where Sam was saying he looks for a 70-30 split, right, Sam? Like, that's what you mentioned when you were looking at the deals. So that's where the passive investors have 70% of the ownership of that LLC that owns the property, and the general partnership has 30%.
Absolutely.
Yep. So the LPs own the majority, but the managers maintain control.
Absolutely. And you rely on them to do all of the hard work and the heavy lifting. You take the risks.
Right.
So how does syndications work? Well, it wouldn't work without our passive limited partners. And their greatest benefits are the 4 main things you see here on the screen. You have the cash flow. That's the thing that Sam was speaking to earlier, where he has invested into deals that had minimal or no cash flow, and that's a no-go. Why? Because we want to pull the money out like a dividend and then reinvest it in other projects. Appreciation, that 70-30 split. When the property sells, the limited partners participate in the upside on the sale. Tax savings through depreciation and cost segregation studies.
Oh, Sam, tell us about your tax experience as a limited.
Oh my gosh. I mean, that's the best part of this whole thing. I mean, with other passive income that I have got coming in, the depreciation expense, I get a negative K1 where in some cases, not all the cases, but in most cases, I get negative K1s that I offset my income. And I think for 2022, I mean, besides my W-2 I get, which I pay taxes on, all my passive income for last year, the tax savings is offset, and I'm not paying a dime of taxes on that. I mean, it's crazy. I mean, Donald Trump said, he uses the tax law and that's what he uses. He uses the tax law to not pay taxes. I mean, the tax law was created by the federal government, and they give us a depreciation to use against your passive income. And it's awesome. It really is. It's the best part, the whole deal.
An incentive to invest in businesses.
Yeah,
definitely.
And then the best part of all, with investing passively in syndications, it allows you to do what you do best, because you don't have to take your time to be a landlord answering phone calls or driving an hour and a half to change the light bulb. Sam, you still get to be the president of a $100 million electrical contracting company in San Diego, and yet you own, pieces of 13 deals around the country, and it sounds like you probably haven't visited many of them or have to be involved in the daily aspect. So
I haven't seen any of them. And the thing is, too, somebody had asked me, is that why did you invest in so many different deals? Well, you know what? It's no different than stocks. You don't want to put all your eggs in one basket. I don't care what anybody says. I believe in spreading your wealth a little bit, a little bit in this deal, a little bit in that deal. And I do believe in spreading the wealth a little bit, because you never know what's going to happen on one deal if one deal goes bad. It's just like stocks. Some stocks will go up, some stocks will go down, and overall you'll make money. I believe in real estate. That's one thing that I can go step on. It's something that's vital. It's not a piece of paper like stocks or your 401k or your IRA. I mean, that's not tangible. At least for me, it's not. I like tangible products. I like something I can go step on, touch, see, and feel. And real estate is that for me.
Love it. Love it. So we were talking about the types of investors and the types of deals. There's two types of syndications and two types of LP investors. So in a 506B syndication, that's one that's not marketed publicly. It's only presented to friends and family. And if you are a friend and family, or we have any kind of pre-established relationship with you, we can share the deal with you, and you can invest even if you're not accredited. If you are a regular person, don't have $1 million net worth, don't make a whole bunch, six-figure, double-digit, six-figure income multiple years in a row, you can invest in those deals. And hey, like, you don't meet the minimums, you can partner up and form an LLC and still invest, like we were saying. And then the accredited investors, they can invest in 506Cs. 506Cs are marketed publicly, but they are only available for accredited investors to invest in. And that is, what is an accredited investor? That's this SEC's definition. Hey, you have to meet certain net worth or income requirements, or you have to have a securities license. You have to have some type of qualification. We were talking about earlier, if you are the general partner on a deal, you are accredited for that deal. It's a qualification. So those are things to consider, but you can also partner. Like, you can also partner with accredited people. And, this is why we just want to make sure that you understand, the rules around how you can invest and when you can invest, and why it's important to establish a relationship as soon as possible. Yes. If you're not accredited and you want to be in an investment in the future. Any comments, Sam? Any other final thoughts or questions from anybody?
I don't have anything. I think it's I've always liked it. I mean, real estate's always something I've always been in. I think a lot of people on the webinar here have been involved in real estate probably for some time, whether their families own property, they own a single family home. I've seen a lot of cases here that are involved in real estate right now. I mean, whether you rent property or are a renter or an owner, you're involved in real estate. You see it.
Absolutely.
100%. So what's the next step?
Get in touch.
Get in touch. So for anybody who we don't have an established pre-existing relationship with in the room, please feel free to use your phone to scan the QR code, and it'll take you to a link to be able to book a call with me, quick 15 minutes to get to know each other, establish that we have a 3 phone call process to get our investors from having no relationship to having actually established relationship where I know them, they know us. We have an understanding that, how the business process works and where they are at in their investment journey. It takes, let's call it a total of about an hour and a half to be able to get through those couple phone calls. Would love to schedule that with any and all of y'all who we don't already have a pre-existing relationship with at this time. And even if you're a person who's interested in being more on the active side, I always recommend establishing that relationship, because if I intend to be a passive investor on other people's deals for a reason, even though I'm active, because you want to be able to spread yourself around and spread your money around to multiple deals, not just the ones that we do, other people's as well. So be willing, especially in the beginning, to invest passively early on, because you can go from passively investing in deals, creating a level of understanding of the industry, build some equity, and then move on to the active role as well.
Roll up the ladder.
Yeah.
So
we're working on new deals all the time.
Right. Big thank you to Sam for being awesome special guest tonight. Thank you so much for your time and for your knowledge and your experience. Really,
thank you for having me. I appreciate it. I did the best I could, and whatever I could offer to other people, that'd be great.
No, this was wonderful. It was a great dialogue. Really enjoyed it. Sorry if we stepped on each other a couple times there. But thank you so much. And again, if you need to access this, you want to watch the recording or come back and figure out what we were talking about when we were on that one slide, you can come to our YouTube channel and watch the recording of this. It will be up in the next day or so. And if you RSVP to this, we're going to email you out that link in a couple days. So again, thank you everybody for attending. Thank you, Sam. And we hope you guys have a wonderful night.
Yeah, I think we only missed one question in the chat.
Oh,
Joe Allen asked, who determines if it's a 506B or C? And that is your SEC attorney who draws up all of your documents. If you have any additional questions, Joe, feel free to use the QR code to book a 15-minute call. We can get to know each other a little bit better on a one-on-one basis.
Yep. Perfect. All right, y'all. Perfect.
Thank you, guys. Appreciate all of you, man. Thank you very much.
Yeah, no, this was wonderful. Thanks for your questions.
Yeah.
Awesome.
Yeah. All right, guys. Have a wonderful night.
Thank you.
See you later.
Bye.